Today's video is about one of the hottest topics in global economics, the European Union's shrinking trade deficit with China. What does this shift mean for the European economy? Before we get started, let's find out what we mean by the trade deficit. So, a trade deficit occurs when a country buys more goods and services from other countries than it sells to them, resulting in borrowing money or selling assets to balance the difference. From 2018 to 2022, the EU's bilateral trade deficit with China expanded dramatically from €154.7 billion to €396 billion. This increase was largely driven by an 83% surge in EU imports from China, reflecting a growing dependence on Chinese goods. This imbalance has been a major focus of economic discussions and policy making within the EU. However, recent data indicates that this trade deficit is now shrinking, signaling a shift in the trade dynamics between these two economic powerhouses. The recent reduction in the EU's trade deficit with China represents a significant shift in the economic dynamics between these two major trading partners. According to the Financial Times, the EU's trade deficit in goods with China fell to €62.5 billion in the first quarter of 2023, marking a 10% decrease from the previous quarter and an 18% decrease year over year. This decline brings the deficit to its lowest point in nearly 3 years, suggesting that the influx of cheap Chinese products, a common concern, is not overwhelming the European market as feared. This narrowing trade gap highlights the effectiveness of European strategies aimed at balancing trade, such as diversifying supply sources and enhancing the competitiveness of European goods. Concurrently, the EU has experienced a surge in demand for its products across the Atlantic, with its trade surplus with the United States reaching a record high in the first quarter of 2023. This positive trend, coupled with the return of the EU trade balance to positive territory after 2 years, underscores the robust health of the European economy. Falling energy prices have played a crucial role in this recovery, providing a more favourable economic environment for European industries. Now, furthermore, traditional strongholds, such as pharmaceuticals and automotive sectors, have maintained historically high trade surpluses, bolstering the EU's overall trade performance. These sectors' resilience is crucial as they continue to drive economic growth and stability within the bloc. In a broader context, the complexities of global industrial and supply chains reveal that trade statistics alone do not capture the full scope of profit distribution in China-EU trade. Notably, over a third of EU exports from China are re-imported to the EU, indicating that European companies are capitalizing on localized production to cater to Chinese consumers. This strategic localization allows European firms to maintain a competitive edge while benefiting from the burgeoning Chinese market. Therefore, despite China's apparent trade surplus, European businesses are reaping substantial profits, contributing positively to the EU economy. This increasing trade between the EU and China has significantly bolstered the European economy, particularly through a surge in exports to China. European companies have expanded their presence in the Chinese market, with key sectors like automotive, aerospace, and luxury goods driving this growth. China, the third largest market for EU vehicle exports, imported passenger cars worth over €24 billion from January to December in 2022, marking a 15.1% increase from the previous year. German car manufacturers such as Volkswagen, BMW, and Mercedes-Benz have seen substantial sales growth in China, with Volkswagen delivering over 3.3 million vehicles in 2022, maintaining a market leadership position with a 15.1% share, despite global challenges like the COVID-19 pandemic and semiconductor shortages. The company's success in the Chinese market, particularly in electric vehicles, underscores the dynamic shift towards fully connected e-mobility, with Volkswagen's ID family of electric cars driving a significant increase in sales. The strategic move of German car makers to deepen their integration into China's innovation system and shift towards a global R&D strategy highlights their commitment to maintaining and expanding their market share. In 2022, EU machinery and transport equipment exports to China reached approximately €120.1 billion, the highest among exported commodities, while food and live animal exports totaled around €11.8 billion. This robust trade growth has not only strengthened economic ties, but also helped to balance the volume of goods imported from China, showcasing the positive impact on the European economy amidst evolving geopolitical landscapes. Global supply chains have been evolving, particularly in the wake of the COVID-19 pandemic. The disruptions caused by the pandemic highlighted the vulnerabilities of over-reliance on single-source suppliers. So as a result, many European countries have diversified their supply chains to reduce dependence on Chinese manufacturing. For instance, the war in Ukraine and rising geopolitical tensions have further stressed supply chains, pushing companies to seek stability through diversification. This has included moving production to Eastern Europe or partnering with suppliers in countries like India and Vietnam, which are emerging as viable alternatives to China. This diversification has contributed to a more balanced trade relationship as European companies increasingly source and produce goods closer to home or in alternative markets. The shrinking trade deficit has profound implications for the European economy. It can lead to increased employment and GDP growth within the EU. For example, the automotive industry, which supports millions of jobs across Europe, has benefited from increased exports to China. This growth in exports helps sustain existing jobs and create new opportunities in manufacturing, research and development. Higher export volumes contribute directly to GDP by increasing the production and sale of goods and services. A reduced trade deficit with China positively impacts the EU's balance of payments, which records all economic transactions between residents of the EU and the rest of the world, including trade in goods and services, primary income and secondary income. In 2023, the EU's trade deficit with China decreased to 291 billion euros, down from 397 billion in 2022, representing a 27% reduction. This shrinking trade deficit helps improve the current account balance, enhancing economic stability. For instance, in 2023, China accounted for 20.5% of EU imports and 8.8% of EU exports. Major imports from China included telecommunications equipment at 56.3 billion euros, electrical machinery 36.5 billion, and automatic data processing machines at 36 billion euros, while key exports to China included motor vehicles. The Netherlands experienced the largest trade deficit with China, nearly 95 billion euros, while Germany had a significant trade surplus. The reduction in the trade deficit reduces the need for borrowing from international markets, which in turn can lower interest rates and promote domestic investment, ultimately fostering economic growth within the EU. The geopolitical landscape is also affected by these changes. A stronger EU economy enhances its political leverage in global affairs, altering the balance of power between major players like the EU, China, and the US. A more balanced trade relationship allows the EU to negotiate from a position of strength on issues such as intellectual property rights, market access, and investment protection. This can lead to more favourable terms for European businesses operating in China, promoting long-term economic growth and stability. EU trade policies have significantly shaped its economic landscape. By focusing on export promotion and securing advantageous trade agreements, the EU has made substantial progress in reducing trade deficits. The EU has signed comprehensive agreements with several countries, including Japan, Canada, and Vietnam. And these agreements not only enhance market access for European goods, but also safeguard European investments. In 2023, the EU's trade surplus in goods reached 38 billion euros, driven by a surplus in chemicals, 198 billion, and machinery and vehicles, 210.6 billion. Additionally, the EU-US Trade and Technology Council continues to bolster transatlantic economic relations, addressing issues like semiconductor supply chains and digital connectivity. The EU-China trade relationship remains critical, with China being one of the EU's top trading partners. In 2023, China accounted for 20% of the EU's imports, primarily in machinery and vehicles, 57%, and then 9% of the EU's exports, highlighting the significant trade volume between the two economies. The EU experienced trade surpluses with China in categories like food and drink, 7 billion euros, and raw materials, 6.3 billion, although it faced deficits in machinery and vehicles, 180.4 billion, and other manufactured goods at 118.3 billion euros. So the future of EU-China trade will hinge on global economic conditions, technological advancements, and geopolitical factors, with ongoing diversification of supply chains playing a pivotal role. Looking forward, the EU aims to balance its trade relationship through continued innovation and proactive policies. The intra-EU trade remains robust, with countries like Germany leading in exports of machinery and transport equipment, and the Netherlands playing a key role in the energy sector. Intra-EU trade integration is evident, with Germany, the Netherlands, France, and Italy being significant importers and exporters within the EU. Policymakers, businesses, and consumers must stay attuned to these dynamics to navigate the evolving global trade landscape effectively. Another critical factor is the environmental policies adopted by both the EU and China. The EU's stringent environmental regulations and its commitment to the Green Deal have spurred innovations in green technologies. These technologies are in high demand globally, including in China, which is also striving to meet its environmental goals. European companies are leading in areas such as EV components, renewable energy solutions, and waste management technologies. This leadership in green technology exports is a significant contributor to the reduction in the trade deficit. Moreover, the EU has strategically invested in enhancing its trade infrastructure. The development of transport corridors, such as the Trans-European Transport Network, has improved connectivity within Europe and with external trade partners, including China. Efficient logistics and transportation systems reduce costs and transit times, making European exports more competitive. This infrastructure development is a key factor in facilitating increased trade volumes and reducing the deficit. Furthermore, it's crucial to analyse the impact of foreign direct investment, particularly within the context of European companies expanding their presence in China. These firms have notably escalated their investments in the region, opting for strategies such as establishing joint ventures and wholly owned subsidiaries to effectively penetrate the local market. This influx of FDI serves dual purposes. It not only streamlines market access, but also equips European enterprises with invaluable insights into and adaptability to local consumer preferences. Moreover, the growing footprint of European entities in China plays a pivotal role in shaping the trade dynamics. Their increased presence contributes significantly to the trade balance, primarily through the stimulation of exports and localized production tailored to meet the demands of the Chinese market. Over the period spanning from 2018 to 2021, the top 10 European investors in China collectively accounted for nearly 80% of total continental investments on average. Notably, German businesses emerged as significant contributors, accounting for over 2/5 of the capital flowing into China from Europe. Finally, it is essential to recognize the broader global economic context. The trade tensions between the US and China have significantly altered global trade patterns. As of 2024, the EU and China have been proactively diversifying their trade partnerships. The EU has focused on bolstering its internal market and establishing new trade agreements, positioning itself as a critical trading partner for China. For instance, China's economic growth for 2024 is projected at 4.6%, indicating a slight recovery from previous years, while the EU and Euro area growth is expected to grow at a more modest 1.1 and 0.8% in 2024. Globally, the economy is set to expand by 3.1% in 2024, with inflation rates declining from 6.8% in 2023 to 5.8% in 2024 and looking at 4.5% in 2025. The US economy, meanwhile, shows resilience with a growth forecast of 2.2% for 2024, although it faces challenges such as high consumer debt and elevated interest rates. Meanwhile, emerging markets and developing economies are expected to grow at 4.2% in 2024, only slightly down from 4.3% at 2023. This geopolitical shift and strategic economic planning have contributed to more balanced global trade dynamics, reflecting the intertwined nature of global markets and the importance of adaptive strategies in response to shifting economic powers. So thanks for watching today's video. If you found this insightful, make sure to give it a thumbs up, share it with your friends, and leave your thoughts in the comments below. What do you think about the EU's shrinking trade deficit with China? We'd love to hear from you. Check out our other videos for more in-depth analyses on global economic trends, and we'll see you next time.